How to identify the bias for the day. There's mainly three ways I use, and we're going to go from least reliable to most reliable. So the first one is a pretty simple one that you can use as a confluence, is to know whether retail traders are selling or buying, right? So you can see how, for example, EU, most of the people are shorting right here. And if we go over EU real quick, you can see that price is consistently going up. At least for the day, it has taken this liquidity. As you know, most of the traders lose, so you want to be apart from the majority, all right? That's the whole principle behind it, because what the retail traders are doing is not what the smart money are doing. One makes money, the other doesn't. The second one will be a simple efficiency, right? If price is efficient or not. Sorry. So efficiency, it's basically saying the market will run like this and testing out previous structure, right? Like in this sense, okay? Such as we got right here. It's basically the same thing. Now, I usually say the price doesn't move like this and it can test out the previous structure. There's a whole nother concept behind it that I'm not going to go over. I made a whole video behind this concept right here that you can go check on how to identify the direction or bias as well. But I'm making this new one a bit better with more concepts. But I usually say the price doesn't move like this, but there's usually traps in these small little structures, okay? So it would be something like there's lows in here that get taken and then price sweeps it and just goes the other direction. It's something like that. But on the bigger picture, it would be something like this. And you can use this because price will most likely test these structures out, right? If price is bullish, it will test like this. And if price is bearish, you do the same thing, coming back to this previous low of structure, right? If price is bullish, then you take the highs of the structure to kind of test them out on the pullback. If price is bearish, then you would take the lows and you would mark them however as you like. I usually do it with blue lines like this. And if price is inefficient, it would look something like this. Something like a low that can never test out the efficiency and just continue to run. In those scenarios, what will most likely happen is that you'll have price coming back to it while sweeping this low. Because people will also most likely be positioning themselves on this low, get trapped, and that sweep of liquidity will give enough fuel, all right? The smart money will pick enough lots in order to buy the lots, the stocks, whatever you're trading, and just continue the overall trend. So the people who have the correct bias, just not the correct positioning or entry, as they will be stopped out right here. And then you have the smart money trap cycle, which is basically we sweep liquidity right here. So now the people that were trying to buy, they get trapped and they see this as a change of character instead of a sweep of liquidity. And so they'll try to short and also get trapped on the shorts, right? And basically you can have some liquidities right here, such as this. And when you have a liquidity sweep plus a touch on the efficiency, that could be a good sign for you to buy or short or trade, right? So in a sense, you can have the small structure right here. You can have the touch of it, but I really prefer more of this case right here, where you can see a clear sweep of liquidity of a major high or low, and then a tap to the efficiency. That's a really good confluence. But then underneath, all right, and this is why you should check the other videos out on lower time frame traps, because a trap like this on a high time frame is not enough. You have to check for high time frame traps as well. That's a topic for another video. But coming over to the most reliable one, and the one I usually like to been thinking the most on in order to determine my bias. Just before we continue the video, I want to let you guys in on a big opportunity that's earned to trade. Literally by their name, I'm gonna show you this. It's the first time I've ever seen this on a futures firm, a scaling plan with the challenges, right? So imagine getting a 50K and turning that same 50K into 400K, right? Just by accomplish the profit targets, right? It's the same with the challenge. You just do 6% and you manage your way until the max allocated capital, right? I have a 50K funded account. So imagine turning that 50K into 400K whilst being super cheap, guys. Look at these prices. So then from this small amount, you can scale it up to the big amounts, right? Even if you're in the 25K and you pay it even cheaper and get yourself a 200K account. But if scaling is not for you, they also got the Gauntlet Mini, which is more of the basic normal type of challenge, and you can get yourself a 200K immediately. These are the current prices for it. As you can see, there's a major discount going, 50% on August. But if you use the code Dylan, you'll actually get 60% with minimum payouts of just $100, no cushion, no buffer. You can just withdraw it as soon as you get it. I've checked the Trustpilot. They have nice reviews, as you can see. Seem legit. So don't hesitate in getting yourself an account. Check the first link in the description. Use the code Dylan. Let's smash it in August and get your name on a certificate. Is where does the most amount of liquidity lies? If you ask yourself that, then most of the times you always get the right direction. That's why I'm always positioning analysis, posting analysis on my premium group, and I'm mostly getting them right. Even though I might not be able to place myself for X, Y, and Z reason, but most of the times I'm always right, and that's because I understand liquidity and I know where the most amount of liquidity lies, right? So in here you can see that price is bullish, right? I don't even have to go for higher time frames. You can see that price is bullish, price testing out efficiency. And what do you have right here? As we're coming to New York session, what do you have right here? We have price breaking lower, sweeping liquidity. We have the London high, which is session liquidity, which is very important. Asia high. You have previous daily high, also another liquidity, and perhaps an overall trend line right here. That should explain to you the overall trend from this move. And also because there was some tariffs news, but news are just setup accelerators, essentially. And DXY, it was destined to go down either way. But if you go over, it's always been like that, right? In this case, we had a sweep of Asia, then it ran. Then we had, coming to New York, we have the London low. And so that's a liquidity, right? And it's overall too easy for the smart money traders. You just have a sweep of Asia low and then a run up, and then it comes back to it, right? We were looking to buy here and here, but we couldn't because I didn't have a second sweep inside of it. That's the lower time frame trap I was talking to you about. So in here we just had normal sweeps, right? In here we had a trapping everybody that was buying around here, trusting the London low, but we didn't have a second trap following it. Because normally, if you're looking for a trap within the day, you have to look it in the sessions. Oh, okay. Just got taken out in the future trade. You got to look into multiple sessions, right? So if let's say you're looking at the lower time frame, right? Say this is a lower time frame and the candles look exactly like this, but all this block, it's inside the same session. Then I'll obviously take this with no hesitation. But because we're in two different sessions, then you got to consider the people that don't trade the session but trade the other, that we must do a second sweep. Well, if you want to be sure about it, right? It doesn't mean I'm always going to get my setup. It doesn't mean I'm always going to get the win. Sometimes the price needs to also give some wins to the smart money traders. But you can see how we stepped on a low. We took advantage of that fuel of sweep of liquidity in order to search for another sweep of liquidity of the previous daily high. Because the market is like the law of cause and effect, right? It takes out the cause in order to give you the effect. And so it's like this. You get in on a day and you see where the liquidity is at. even if you're not sure, you just come in a day and you see price ranging, right? You come in a day and see price ranging. But you tell yourself, well, I have this liquidity right here, let's say, and I have this liquidity right here. And so the only thing you have to do, really, it's wait for price to take one or the other. And then you can buy or sell accordingly. If price comes here, then you look to sell. If price comes down here, then you look to buy. It's pretty simple. It's pretty simple. It's just a matter of patience, right? Because you can be identified these high time frame liquidities, or not even a high time frame, but just within the day range, right? It could be Asia, it could be the London, the sessions liquidity, like London. It could be the previously high, previously low. But sometimes even those can be internal within this same range, and those are more risky. Some of the times, a lot of your losses might become from that. It's because you're playing the risky setups inside the range. But if you're playing outside of the range, meaning you're trading externally, then you get a way more likelihood of your trade succeeding. This is if you're trading liquidity, for example. That's why I always have liquidity above, liquidity below, see one get taken, and I might position myself. If I get one internally, I might buy in this scenario, right? In order to take the other liquidity, because the internal trades would be risky trades, will have less of success, and you can use them to search for the big liquidity that you're targeting, or you can wait for the big liquidity to get taken itself, and then you have the safe setup, which would be the short or buy, depending on where the liquidity was, upside, downside liquidity, right? But there's a multitude of examples. You come in a day and just check where the most amount of liquidity lies, and that's probably where price is going to head, right? Come right here, previously low, previously high. That's a pretty basic liquidity that you can use, and pretty damn good. Previously low, previously high. You mark those out. You mark out Asia. Again, if you have Asia right here, Asia low, but then you have the previously low, just keep in consideration of the previously low or the structure that's just next to it, right? Because if Asia is right here, but then you still have bits of structure right here, then of the overall low, then there's no point in just counting Asia. You have to take the whole thing. Because see what happens here? We sweep Asia and we run a bit up. At the same time, we do a support with this. So some guys that trade the Asia session liquidity sweep, they might have gotten trapped. They don't zoom out. They might be buying at the same time as support resistance traders as buying here in the low of the day. And then, guys, previously low swept, previously high swept, and see where the market moves, right? I'm just going off recent price action. I'm not searching for a perfect week. This is just my strategy. And if you want to learn more about it, you can just go over my channel. But in regards to the topic video of the bias, just look for the liquidities, right? That's the best you can do. Previously low, boom, right here, and Asia, right? And you have sweep of Asia, then sweep of Asia. And here it didn't, but watch how he comes back to it later on, right? So that's about it. Remember, you can use the forex sentiment as a confluence of the retail traders and just do the opposite. If most people are shorting, then you look for buys. If most people are buying, then you look for sells, right? You're going to go over the charts. You're going to see that, wait a few days, and you're going to see that whatever they were trying to anticipate, they were completely wrong. And even if they're right, then they lost a bunch of positions already before they even got a win, right? They might be, for example, shorting this move, right? Trying to short. And let's imagine EU goes down from here, but they may get a win here, but it will not cover for all the losses they got previously from trying to short the move that was just going up, right? Second one is the efficiency. Pretty basic. Try to adopt this. It's a bit of support resistance, but works pretty well if you adopt some liquidity concepts between it. But the best one, and obviously with the one which I'm always using, the one which I'm always seeing, as soon as I get in on the markets, is I identify where the most amount of liquidity is, where's the structure, pick up the major ones, the previous daily high, previous daily low, for example, pretty basic ones, the sessions liquidity. If you're trading London, then look for Asia to get swept. If you're trading New York, look for Asia and London to be swept, and the previous daily low, previous daily high, because you're going to get some movement out of the session. And I guarantee you, you do this example and go over your charts, identify these type of liquidities, and you'll see where market goes and reacts from. Right? It isn't magic.